This deep dive is brought to you by CertFuel. They've got a full Securities Industry Essentials course with adaptive study quizzes, smart flashcards, and unlimited practice exams that are weighted just like the real thing. So check it out at certfuel.com.
I highly recommend it.
Yeah, it's great stuff. All right, so I want you to imagine this massive, complex industrial machine. Just thousands of moving gears, hidden levers, trapdoors, the whole deal.
Sounds dangerous.
Oh, it is, because if you walk up to this machine and just, start blindly pressing buttons, it will absolutely shred your wallet to pieces.
Right, yeah.
But if you understand the blueprints, if you know why the gears turn the way they do, you can actually use that machine to build generational wealth.
Which is the whole point.
Exactly. So today we are opening up the blueprints to the most popular and honestly the most misunderstood wealth-building machine in the entire modern financial system. We are talking about packaged products.
It's a really fitting analogy. And, if you're out there studying for the SIE exam, this particular machine is one you absolutely have to master intimately.
Yeah, it's huge, right?
It's staggering. Packaged products, which realistically mostly means mutual funds and all their weird cousins, they make up a massive 44% of the entire exam.
44%. That's almost half the test.
Exactly. You cannot fake your way through this section. You can't just memorize a textbook definition of a mutual fund the night before and expect to pass.
Right, because they trick you.
Oh, they actively hunt for people who only know the what but don't understand the why.
Yeah. And that is the core mission of this deep dive today. We are not going to sit here and read you a dry textbook.
Nobody wants that.
No, textbooks put me to sleep in about 4 minutes flat. Instead, we're going to logic our way through these rules. Because if you understand why the Securities and Exchange Commission, the SEC, created a rule in the first place.
You don't even need to memorize it.
Exactly. You just intuitively know the answer when you see some bizarre, multi-layered trick question on the test.
And believe me, they will throw bizarre scenarios at you. They want to test your judgment.
Which is why we've brought in a cast of characters for today's journey. We're going to use 3 fictional but painfully realistic investors to test these rules.
I love these guys.
Right. You're going to get very familiar with them, listener. First up, we have Baller Brenda.
Baller Brenda. She is playing the long game. She has a mountain of cash. She's highly successful. And she's investing for decades down the line.
Decades.
Yeah. And because she has so much capital, she expects VIP treatment. She loves finding volume discounts. And she is perfectly fine paying a huge cover charge up front if it means her long-term costs drop to the absolute floor.
I love Brenda. She's got that quiet, wealthy confidence. But then on the complete opposite end of the spectrum, we have short-term Sam.
Sam is exhausting.
He really is. Sam's financial strategy is essentially powered by energy drinks and anxiety.
Yep. 0 attention span.
0. He hates waiting. He constantly tries to jump in and out of investments, chasing yesterday's news, and he almost always does this to his own detriment.
If there's a way to incur a short-term penalty, Sam will find it.
He will. And our third character is Cautious Carl. Carl is terrified of losing a single dime.
He treats every financial product like it's a scam.
Totally. He wears a metaphorical tinfoil hat when he looks at management fees. He's always trying to outsmart the IRS.
And ironically, because he's so obsessed with avoiding risk, he constantly gets tangled up in the very regulatory nets designed to protect him.
It's tragic. So I've got Brenda, Sam, and Carl. Keep them in your head. They are going to make some brilliant and some utterly disastrous financial decisions today.
So where do we start? How do we even begin to unpack 44% of the SIE?
We have to start at the bedrock. Before you can buy a fund, before Brenda can demand her VIP discount, you have to know what the government actually allows to exist. We need to look at the legal building codes.
Right. Specifically, the Investment Company Act of 1940.
Okay, I want to pause right there.
Right.
Why 1940? What was the SEC doing? Because, the Securities Act of 1933 regulated new issues, the primary market. And the Exchange Act of 1934 regulated the secondary market, the trading. So they had the markets covered. Why wait until 1940 to write a whole new rule book?
You really have to look at the historical context here. Think about the 1920s, before the Great Depression. Wall Street had these things called investment trusts.
Which were what exactly?
They were essentially unregulated, massive pools of money. Everyday people would hand their cash to some hot-shot manager, and that manager could literally do whatever they wanted.
Oh, wow. So no rules at all.
Basically none. They could borrow massive amounts of money to leverage the fund, they could buy their buddies' terrible stocks to bail them out, or they could just quietly drain the fund with hidden fees.
So it was just the Wild West. You hand your money over, and the guy running the pool is basically playing roulette in the dark with your life savings.
Precisely. And when the crash of 1929 happened, these unregulated trusts didn't just lose money, they imploded. They wiped out millions of retail investors completely. Yeah. So it took a decade of investigations for Congress and the newly formed SEC to fully understand the damage. By 1940, everyday people were finally starting to get back on their feet. They wanted to invest again.
But they wanted professional management.
Exactly.
Yeah.
So the SEC stepped in and said, never again. If you are going to take pooled money from the public, you have to build your financial house according to these exact, highly specific blueprints.
And that blueprint is the Investment Company Act of 1940.
It is the ultimate consumer protection rulebook for packaged products.
That makes total sense. Like, you can't just build a skyscraper out of paper mache and call it an office building. The building code says you need steel beams.
Right.
So the ICA says if you pool investor money, you must be legally classified into one of 3 distinct buckets. And this brings us to the first major conceptual trap that catches so many people on the exam.
Oh, this is a big one.
Yeah, the difference between Section 4 and Section 5 of the 1940 Act.
This is a classic layered gotcha. You really have to be incredibly precise with your terminology here. Section 4 of the Act classifies investment companies into exactly 3 broad types.
Not 2, not 4.
Exactly 3.
Okay, let's look at the 3 legal buckets under Section 4. Type 1, the face amount certificate company.
Which, for all practical intents and purposes, is an extinct dinosaur.
Really? Like, nobody uses them.
Basically nobody. These companies issue certificates promising to pay a fixed sum at a specific maturity date in exchange for an investor making periodic installment payments.
Like layaway for a bond.
Kinda, yeah.
Yeah.
They were popular before modern banking and mutual funds took over. Today, you will almost never see these in the real world. They are financial fossils.
But the exam still tests them.
Oh, absolutely. The exam requires you to recognize the name. If you see face amount certificate company, you just need to know it is one of the 3 Section 4 classifications.
Got it. It's the trivia question you just have to log in your brain. All right, type 2. The Unit Investment Trust, or UIT. We are going to spend a lot of time on these weird little pre-packed lunchboxes later, so we won't dive deep just yet. But just know it's bucket number 2, which leaves bucket number 3.
Type 3. Management companies. This is the behemoth. This is where the vast majority of pooled investments operate today. This is the bucket that contains mutual funds.
Okay, listener, I am talking directly to you right now. Stop whatever you are doing and think for a second. If the exam asks you, under which section of the Investment Company Act of 1940 is an open-end mutual fund subclassified? Is the answer Section 4 or Section 5?
Let them think about it.
Okay, expert, what's the answer?
The answer is Section 5.
And why is that a trap?
Because Section 4 gives us the 3 main overarching types. But Section 4 does not use the words open-end or closed-end.
You're right.
It's Section 5 that takes that 3rd bucket management companies and puts a microscope on it. Section 5 subclassifies management companies into open-end versus closed-end, and also into diversified versus non-diversified.
Ah, I see how they get you. An anxious test taker sees mutual fund, remembers it's a management company, and circles Section 4.
Yep. But Section 4 just says it is a management company. Section 5 gets into the weeds of how that management company actually operates.
Exactly. And speaking of the weeds of Section 5, we have to talk about that word diversified, because the SEC does not use that word the way normal human beings do.
No, they really don't.
Like, if I go to a party and tell my friend, hey, I bought some Microsoft, some Apple, and a little bit of Tesla, I'm diversified, my friend might agree.
Sure.
But if I say that to an SEC regulator, they're going to laugh in my face. Because under Section 5, diversified is not a vibe. It's not a feeling. It is a strict mathematical legal equation.
It's the 75-5-10 rule.
Break that down for me.
If a management company wants to put the word diversified in its prospectus and legally market itself as a diversified fund, it must pass a rigid test. The rule states that at least 75% of the fund's total assets must meet 2 very strict conditions.
Okay, condition 1.
First, no more than 5% of the fund's total assets can be invested in the securities of any one single issuer.
Okay, let me break this down with a culinary analogy, because math sometimes makes my eyes glaze over.
Go for it.
Imagine you are making a legally compliant fruit salad. The bowl represents your entire fund. The SEC comes into your kitchen and says, look, we don't care what you do with 25% of this bowl. You can shove an entire unpeeled pineapple into that 25% corner. We don't care.
A whole unpeeled pineapple.
Yeah, it's unregulated. But the remaining 75% of this bowl must be a true regulated mix.
And that's where the 5% rule kicks in. Of the assets in that 75% chunk, you cannot have more than 5% represented by a single stock.
Right. So inside that regulated 75% of the bowl, you can't just fill it all with watermelon. Watermelon can only make up 5% of the total bowl. It forces the chef to use a ton of different fruits.
Great analogy.
Thanks. But wait, what is the 10 in the 75-5-10 rule?
So the 10% rule addresses a completely different risk. It says the fund cannot own more than 10% of the outstanding voting stock of any single target company.
Why? I get the 5% rule. It stops the fund from putting all its eggs in one basket. If the watermelon goes bad, the whole salad isn't ruined. But why does the SEC care if the fund buys up a massive percentage of a single company's stock as long as it stays under the 5% limit of the fund's own assets?
Think about what happens when you own a massive block of voting stock in a corporation.
You get a say in how it's run.
Exactly. You get a seat at the table. You get to dictate board members. You get to influence corporate policy. You essentially become an activist investor.
Ah, I see.
The SEC created mutual funds to be passive investment vehicles for everyday people. They did not want these funds acting like hostile takeover machines or private equity sharks. If a mutual fund buys up 30% of a small regional bank, that fund now basically controls the bank.
Wow.
Yeah. So the 10% rule prevents a diversified mutual fund from gaining controlling interest in other corporations.
That is fascinating. It's a firewall. It keeps mutual funds in their lane. They are supposed to be picking stocks, not running companies.
Exactly. So, to recap the math, at least 75% of assets must be invested such that no more than 5% is in any one issuer, and the fund owns no more than 10% of any one issuer's voting stock.
And what if they sail that math?
Here is the binary legal reality. If a fund fails that math, even by a fraction of a percent, it is legally classified as a non-diversified management company.
Okay, so we've established the legal building codes. We know what a management company is. Now let's zoom in on the two heavyweight champions of the packaged products world. These two structures are going to totally dominate your exam.
Yes, they are.
I am talking about open-end funds versus closed-end funds.
This is the absolute core of the market. Let's start with open-end funds. When a normal person on the street says mutual fund, they're almost always talking about an open-end management company.
Okay.
The defining characteristic is right there in the name. It is open.
Meaning the front doors are propped wide open, 247.
Legally speaking, it means the fund is engaged in a continuous primary offering of shares. There is no fixed number of shares out there in the world.
Wait, so if Baller Brenda walks into the fund company today with $5 million and says, I want in, what happens? The fund company doesn't go look for someone willing to sell to her, do they?
No, not at all.
Right, they just spin up the money printer. The fund creates brand new shares for Brenda out of thin air, takes her $5 million in cash, and the portfolio manager uses that fresh cash to go buy more underlying stocks.
The fund just got physically bigger.
Yeah.
And the reverse is equally true. Let's look at short-term Sam. If Sam gets panicked by a news headline and wants to sell his shares, he doesn't have to go find a buyer on the stock market.
Which is what you do with a normal stock.
Right. But with an open-end fund, he goes directly back to the fund itself. The fund takes his shares, effectively destroys them, and hands him his cash out of the fund's reserves.
So an open-end fund is a living, breathing entity. It is constantly expanding as money flows in and contracting as money flows out.
It breathes like a lung.
That's a great way to put it. But because it's constantly expanding and contracting, and because you are dealing directly with the fund company, the way these shares are priced is totally unique. And honestly, it is highly counterintuitive if you are used to buying normal stocks.
You are talking about forward pricing, and you are correct. This trips up a massive number of test takers because it defies how we buy almost everything else in the world.
Let me set the scene for the listener. Buying an open-end mutual fund is exactly like walking into an absurdly pretentious, ultra-high-end restaurant where there are absolutely no prices on the menu.
I hate restaurants like that.
Right. So you sit down at 1 p.m., you tell the waiter, I will have the steak. The waiter says, excellent choice, and takes your menu away. You are now legally committed. You have bought the steak.
But you have no idea what your bill is going to be.
Zero idea. You don't find out what the steak costs until the restaurant closes its doors at 4:00 p.m. Eastern Time.
Which is stressful.
Incredibly. At that exact moment, the chef goes into the kitchen, calculates the exact market value of every single ingredient in the pantry, divides it by the number of diners in the restaurant, and then prints your receipt.
In financial terms, that receipt is the net asset value, or NAV.
NAV.
Because an open-end fund doesn't trade on supply and demand, its price is strictly derived from the actual value of the assets it holds. The formula is simple. Total assets of the fund minus total liabilities divided by the number of outstanding shares.
But the timing is the trap here. Why 4:00 p.m. Eastern?
Because that is when the New York Stock Exchange officially closes for the day. You can't calculate the exact value of a portfolio of stocks while the prices are still fluctuating minute by minute.
Right, that makes sense.
The fund has to wait for the closing bell. They take the final closing prices of all the stocks they own, run the math, and calculate the NAV. By law, they must do this at least once per business day.
So, if I place an order to buy a mutual fund at 10:00 a.m. on a Tuesday, I don't get Tuesday morning's price. I get whatever the price turns out to be at 4 p.m. Tuesday afternoon. I am pricing forward to the next available calculation.
Correct. Now hold on. A lot of people ask, why don't they just let you buy at yesterday's closing price? Wouldn't that be easier? At least you'd know the price up front.
Oh, I know exactly why. Because if they let me buy at yesterday's known price, I would rob them blind.
Exactly.
Think about it. Let's say yesterday's NAV was $10. Today, the Federal Reserve announces an emergency rate cut at noon, and the entire stock market explodes upward by 5%.
Which happens.
Yeah. If I could still buy into the mutual fund at yesterday's $10 price, knowing full well the underlying assets are already worth $10.50 today, it's literal free money. I would drain the fund of its value.
Which harms all the long-term investors like Brenda who are already in the pool.
Right. Forward pricing eliminates arbitrage. It ensures everyone is treated fairly based on the closing value of the assets. You cannot game the system by trading on intraday news using stale prices.
Which brings us to short-term Sam.
Oh, Sam.
Sam thinks he's a genius day trader. It's 3:55 p.m. He's watching the Financial News Network, and a massive positive jobs report drops. The market is surging into the close.
He's getting frantic.
Oh, totally. Sam scrambles to his phone, opens his brokerage app, and at exactly 4:01 p.m. Eastern, he hits buy on a massive tech mutual fund. He's smiling, thinking he just caught the wave of the day. Listener, what is about to happen to Sam?
I'll give you a second to think about it.
Sam is about to get a very frustrating reality check.
Why?
Because he hit that button at 4:01 p.m. He missed the 4:00 p.m. cutoff. He does not get today's closing price. His order is now pushed forward to the next available calculation.
Oh, no.
Yep. He is locked in to receive tomorrow's closing NAV at 4:00 p.m. on Wednesday.
He is completely at the mercy of the market for the next 24 hours. If the market tanks tomorrow morning, he is buying in at whatever that new, potentially terrible price is.
It's a huge risk for him.
The exam loves testing that cutoff time, listener. If you order after 4:00 p.m. ET, you get the next business day's NAV. Period. And do not let them trick you with time zones either.
Oh, good point.
If you are in California and you place an order at 1:01 p.m. Pacific time, you missed it. That's 4:01 Eastern.
Now, let's look at the other side of the transaction. What happens when Sam finally decides he's had enough and wants to sell his shares back to the fund? He hits the redeem button. How long does the mutual fund have to actually wire him his cash?
I mean, I would assume standard settlement times, like T+1 or T+2.
No, this is governed specifically by the Investment Company Act. The law requires open-end funds to send the investor their money within 7 calendar days of receiving a proper, in-good-order redemption request.
Okay, let me flag this for the listener. Did you hear the specific word the expert just used? 7 calendar days.
It's a huge distinction.
Wow. The exam will give you a multiple-choice option that says 7 business days. It will look so incredibly correct. You will want to click it. Do not click it. Why is it calendar days and why 7?
It's a strict liquidity mandate. The SEC wants to guarantee that everyday investors can get their hands on their life savings within a week no matter what.
Which makes sense.
If it were 7 business days, a holiday weekend could stretch that wait out to 10 or 11 actual days. The SEC says no, 7 calendar days. You must manage your portfolio liquidity so you can always meet redemptions. It prevents a mutual fund from trapping your money during a market panic.
Okay, so that is the open-end mutual fund universe. Continuous shares, expanding and contracting, forward pricing at the 4:00 p.m. NAV, and 7 calendar days to redeem.
Now, we have to flip the coin completely. We're looking at closed-end funds.
Right, and if you take everything we just said and invert it, You basically get a closed-end fund.
That's a great way to look at it. A closed-end fund takes a fundamentally different, much more traditional corporate approach to raising money. They do an initial public offering, an IPO.
Like a regular tech startup going public.
Exactly. The managers go to the public and say, we are launching a new fund. We are issuing exactly 10 million shares at $20 a piece. Who wants in?
And once they sell those 10 million shares and raise their $200 million, what happens?
The doors slam shut, hence the name closed end. The fund has its capital. It does not issue any more shares to the public. And crucially, unlike a mutual fund, the fund does not redeem shares.
Wait. Let's bring cautious Carl into this. Carl buys into the IPO. 6 months later, the market gets rocky. Carl is sweating through his shirt. He calls the fund company and says, I want out. Here are my shares. Give me my money back. What does the fund company tell him?
They tell him, sorry, Carl, we don't do redemptions. We invested your money. We bought illiquid municipal bonds. We bought emerging market debt. We can't just sell our assets today because you got nervous. If you want out, you have to find someone else to buy your shares.
And where does Carl find this magical other person?
On the secondary market. Closed-end funds are listed on major stock exchanges, like the New York Stock Exchange or the NASDAQ.
Ah.
Carl has to call his broker and sell his shares on the open market to another investor exactly the same way he would sell a share of Apple or Coca-Cola.
Which completely fundamentally changes the pricing dynamic. Open-end funds are the restaurant with no prices, based purely on the NAV of the ingredients. Closed-end funds are like buying scalped concert tickets in the parking lot outside a stadium.
That is the perfect analogy. Let's explore that.
Okay, so the closed-end fund calculates its NAV. The actual value of the stocks it holds divides out to exactly $10 per share. But the fund is managed by a legendary Wall Street superstar who just had a massive year. The fund is famous. It's the hottest ticket in town.
Everyone wants a piece.
Right. So because the supply of shares is permanently fixed at 10 million, what happens when 20 million people want to buy in?
Supply and demand take over. The actual assets are only worth $10. But investors on the stock exchange are fighting over the limited shares. They bid the price up.
Just like a scalped ticket.
Yes. Someone might be willing to pay $11 or even $12 for a share that is fundamentally only worth $10. When a closed-end fund trades for more than its net asset value, we say it is trading at a premium.
You are paying a premium just for the privilege of getting a seat in the stadium. But it swings the other way, too, right?
Yeah, it absolutely does.
Yeah.
Let's say the legendary manager retires. The new manager is terrible. The fund is losing money. Carl is panicking and wants to sell, but nobody wants to buy.
Yikes.
The underlying assets in the fund are still worth $10 a share. But to convince someone to take these cursed shares off his hands, Carl has to lower his asking price to $9.
Now the fund is trading at a discount to its NAV. This is a massive neon flashing exam concept, listener. If a test question ever mentions a fund trading at a discount or a premium to its NAV, or if it says a fund is trading below its net asset value, you immediately know it's a closed-end fund.
Host, ask them why. Why can't a mutual fund trade at a discount?
Let me ask you, listener, why can't an open-end mutual fund trade at a discount? Think about it.
It's because of the redemption feature we just discussed.
Right. If an open-end mutual fund has an NAV of $10, you can always legally go directly to the fund and demand your $10. You would never accept $9 from a guy in an alleyway when the fund company is legally obligated to hand you $10.
Therefore, open-end funds can never trade at a discount. Closed-end funds don't have that safety valve, so supply and demand rule completely.
Okay, I'm going to throw a scenario at you, listener. Let's see if you can logic your way through this based on everything we just learned.
This is a good one.
Short-term Sam wants to try out some highly aggressive, highly risky trading strategies. He wants to buy a fund on margin, meaning he wants to use borrowed money from his broker to double his position. And next week, he wants to short sell a fund, betting that its price will go down.
Typical Sam.
Yep. Which type of fund can Sam use for these strategies? Open-end or closed-end?
Give him the beat.
Okay, expert, break the silence. What's the answer?
Sam must use a closed-end fund. He cannot buy an open-end mutual fund on margin, and he cannot sell an open-end mutual fund short.
Why? I hate just memorizing. You can't do this. What is the underlying logic that makes the SEC forbid margin on mutual funds?
It goes right back to the structural blueprints.
Okay.
Open-end funds are continuously issuing new shares, right?
Yeah, the money printer.
Under the Securities Exchange Act of 1934, you cannot use margin to purchase a new issue, a primary offering, because a mutual fund is technically in a continuous primary offering. Buying a new share directly from the fund is a new issue. Therefore, no margin.
That makes perfect sense.
Plus, mutual funds have to be ready to pay out redemptions in 7 calendar days. They rely on stable, fully funded capital. They're not designed to be speculative, debt-fueled trading vehicles.
But closed-end funds are already out there in the wild.
Exactly. The closed-end fund already did its IPO years ago. Now, those shares are just floating around the secondary market on the NYSE. Because they trade just like normal corporate stock, they are subject to normal stock trading rules.
So you can buy them on margin, you can short them, you can place limit orders, stop-loss orders.
You can't do any of that with an open-end fund because you only get one price a day, the 4-1 train PM NAV.
And what about the funds themselves? Can the manager of the fund borrow money?
Great distinction. Yes, closed-end funds are legally permitted to issue preferred stock or issue bonds to borrow money to leverage their own portfolios. They have a standard corporate capital structure. Open-end funds are strictly limited. They generally only issue one class of common voting stock and cannot issue bonds or preferred shares.
Okay, we need to cement this before we move on. This is too important. We are going to do a rapid-fire side-by-side comparison. Listener, I'm going to list a feature. You tell me if it belongs to an open-end fund or a closed-end fund. Try to beat the expert to the punch. Ready?
Let's do it.
Fixed number of shares.
Closed-end.
Must redeem shares within 7 calendar days.
Open-end.
Traded on a secondary exchange.
Closed-end.
Priced via forward pricing once a day.
Open-end.
Can trade at a 5% discount to its NAV.
Closed-end.
Can be bought on margin.
Closed-end.
If you nailed that, you just secured a massive chunk of points on the SIE. But we have a lingering loose end. We talked about Section 4 of the 1940 Act having 3 buckets. We killed the dinosaur, the face amount certificate. We just spent 20 minutes dissecting the giant, the management company. But what about the oddball in the middle? Bucket number 2, the unit investment trust.
The UIT. It is the oddball because it strips away the one thing people usually pay a fund company for, active management.
What if you want the massive diversification of a fund, but you absolutely fundamentally do not trust some hotshot Wall Street manager in a tailored suit to actively buy and sell stocks with your money? Cautious Carl falls into this camp. He thinks every manager is just gambling.
For Carl, the financial industry created the Unit Investment Trust. A UIT is a pooled vehicle where the portfolio is assembled exactly once, locked in a vault, and then never actively managed again.
It's the pre-packed lunchbox analogy. When I was a kid, my mom would pack my lunch. Once she closed the lid and sent me to school, the contents of that lunchbox were fixed. If it was a turkey sandwich and an apple at 8:00 a.m., it was going to be a turkey sandwich and an apple at noon.
Right?
The sandwich wasn't actively trading itself for a slice of pizza in the hallway.
That is exactly how a UIT functions. A financial sponsor creates the trust. They go out and buy a very specific basket of securities, usually a portfolio of bonds, maybe 50 different municipal bonds. They put those exact 50 bonds into the trust, seal the legal documents, and sell units of beneficial interest to investors like Carl.
Because there is no chef in the kitchen, what does that mean for the corporate structure?
This is the highly testable part. Because the portfolio is fixed, a UIT has no investment advisor. There is nobody making daily buy and sell decisions, so you don't need to pay an advisor a management fee. And because there is no corporate strategy to oversee, a UIT has no board of directors.
No manager, no board of directors. That sounds like a ghost ship. Who is actually flying the plane? It's overseen by a trustee. But the trustee's job is purely administrative. They don't pick stocks. They just collect the interest payments from the 50 bonds in the vault, take a tiny administrative fee, and mail the remaining cash out to the unit holders. It is a strictly passive vehicle.
Carl is drooling right now. He loves this. He says, you mean I can look at the prospectus today, see exactly which 50 bonds are inside, and know with 100% certainty that those exact same 50 bonds will be there 5 years from now? Yes, Carl. No style drift. No manager getting cocky after a good year and secretly buying speculative crypto startups. It is a sealed vault.
But you have to understand how a UIT eventually dies. Because the portfolio is almost always composed of bonds, and bonds have maturity dates, a UIT has a stated termination date.
It comes with an expiration date stamped on the tin. Exactly. As the bonds inside the vault mature, or if a bond is called early by the issuer, the trust receives cash. And here is the critical rule. That cash is never reinvested into new bonds. The trustee simply distributes that principal back out to the investors. Eventually, when the final bond matures, the vault is completely empty, the trust dissolves, and the UIT ceases to exist.
Okay, let's test a scenario, because the exam loves to conflate the portfolio with the investor. Cautious Carl buys into a UIT. It has a stated termination date, 10 years in the future. 5 years in, Carl's roof caves in. He has a massive financial emergency and needs his cash immediately. Can he get out, or is he legally locked in until the 10-year termination date?
He can get out. This is a brilliant exam trap. Do not confuse a fixed portfolio with a locked-up investor. Even though the bonds inside the trust cannot be traded, the actual units that Carl owns are redeemable.
Redeemable. That's the same word we use for open-end mutual funds.
Yes. If Carl needs his money, he can sell his units back to the trust at their current net asset value. The trust will pay him out. So UIT is defined as having redeemable units, but a fixed, non-managed portfolio.
Beautiful. Redeemable units, fixed portfolio, no board of directors, no investment advisor. That is the UIT. All right, take a breath, stretch your legs. We have officially built the legal structures. We understand the buildings. Now we need to talk about the blood that pumps through Wall Street, money, specifically fees and share classes. Because nobody, not the broker, not the fund manager, not the SEC, is doing this out of the goodness of their hearts.
They certainly are not. Wall Street gets paid, and the exam wants to make sure you know exactly how they extract that payment from the investor. We need to define two key terms before we get into characters. We already talked about NAV, the net asset value. That's what the raw ingredients of the fund are worth. But when you go to buy a mutual fund from a broker, you don't pay the NAV. You pay the POP.
The public offering price.
Correct. The formula for POP is simply the NAV plus a sales charge.
NAV plus load equals POP. A sales charge is often called a load. It is simply the commission paid to the broker who sold you the fund. So you buy into the fund at the higher POP, and when you leave, you redeem your shares at the lower NAV. The gap between those two numbers is the toll you paid to cross the bridge.
But when and how you pay that toll depends entirely on what class of shares you purchase. Every mutual fund essentially chops itself up into different classes, usually Class A, Class B, and Class C. The underlying stocks in the portfolio are exactly the same, but the fee structures are radically different.
Let's start with Class A shares. The front-end load, this is Baller Brenda's absolute favorite territory.
Class A shares are exactly what they sound like. You pay the sales charge right at the front door before you even enter the party. The regulatory maximum for a front-end load is 8.5% of the public offering price.
Okay, let's run a real scenario because the math here is a massive trap. Brenda decides to invest a clean $100,000 into a Class A mutual fund. The fund charges a 5% front-end load. She hands the broker a check for $100,000. What actually happens to her money?
This is where people get confused by comparing it to sales tax. If you buy a $100 TV with a 5% tax, you hand the cashier $105. That is not how mutual funds work. Brenda's check is for $100,000. The 5% load is deducted from her investment immediately. 5% of $100,000 is $5,000. That $5,000 goes straight into the broker's pocket as a commission.
It vanishes. Poof. Gone.
And the remaining $95,000 is what actually gets invested into the mutual fund at the NAV. Her opening balance on day one is only $95,000. The load reduces the amount invested.
Hold on. You are telling me Brenda, who is incredibly smart with money, a total baller, just voluntarily agreed to light $5,000 on fire the second she walked in the door. Why on earth would anyone agree to that? Why not pick a class with zero upfront fees?
Because Brenda understands the long-term math. Class A shares inflict pain up front, but in exchange, they have the absolute lowest ongoing internal fees. Once she pays that cover charge at the door, her drinks inside the club are practically free. If she's planning to keep her money in this fund for 20 years, paying a one-time 5% fee is vastly cheaper than paying a high internal drag every single year for 2 decades.
Pay up front, save later, large sum of money, long time horizon. That is the formula for Class A. But what if you hate the idea of losing principal on day one? That brings us to Class B shares, the back-end load.
Class B shares appeal psychologically to people who want all their money working immediately. If you invest $100,000 into a Class B share, exactly $100,000 goes into the market on day one. Zero upfront fee.
That sounds amazing. Where's the catch? Because Wall Street isn't working for free.
The catch is at the exit door. Class B shares carry a contingent deferred sales charge, or a CDSC.
A contingent deferred sales charge. That is a mouthful of bureaucratic jargon. Break it down.
It means the fee is contingent upon how long you stay in the fund, and the charge is deferred until the moment you decide to leave. Typically, the CDSC is on a declining schedule. Let's say you invest today and panic sell next year. The fund might hit you with a massive 5% exit fee on your way out. But if you hold on until year 2, the fee drops to 4%. Year 3, it's 3%. Usually by year 6 or 7, the exit fee burns off completely and drops to zero.
So the longer you stay, the cheaper it gets to leave. It's like a financial hostage situation that slowly de-escalates over 7 years. But wait, if I stay for 7 years, I pay no front load and I pay no back load. How did the broker get paid?
Through the hidden internal fees. While you are waiting out that 7-year hostage situation, Class B shares are charging you significantly higher ongoing annual fees, specifically a 12B1 fee, which we will define later, but it can be up to 1% of your assets every single year. You didn't pay the cover charge at the door, but you are paying $20 for a glass of water inside the club.
It's a slow bleed. But there is a silver lining to Class B shares, right? A transformation.
Yes, the conversion feature. Once that CDSC schedule fully burns off, say after year 7, most Class B shares will automatically convert into Class A shares. From that point on, your high internal fees drop down to the lower Class A level. You survive the gauntlet, and now you get the cheap rates.
Now, listener, I need to break the fourth wall for a second and give you a harsh dose of reality. In the actual modern financial world of 2026, Class B shares are basically extinct. Nobody buys them. Most fund families have completely eliminated them from their lineups because they were too confusing and generated too many regulatory complaints. But UITET, the SIE exam, exists in a vacuum. It does not care about the real world. The exam will still test you heavily on Class B shares. You must remember the declining CDSC and the conversion to Class A.
Which leads us to the third major category, Class C shares, the level load.
This is short-term Sam's territory. Sam doesn't have Brenda's $100, and he sure as hell does not have the patience to sit in a fund for 7 years waiting for a Class B fee to drop to zero. How does Class C cater to Sam's frantic energy?
Class C is the pay-as-you-go plan. There is no front-end load at all. All your money goes to work on day 1. There is a back-end load, but it's very small, usually just 1%, and it only lasts for exactly 1 year.
So if Sam holds the fund for just 13 months, he paid nothing to get in, and he pays nothing to get out. Sam is thrilled. He thinks he just hacked Wall Street. He found the loophole. What is Sam missing?
Sam is missing the devastating reality of the ongoing internal fees. Class C shares have the highest persistent internal expenses of any share class. They generally charge the absolute maximum 12B1 fee of 1% every single year. And here is the brutal exam favorite trap. Class C shares never convert to Class A.
Never, ever.
Never. If Sam buys a Class C share, forgets his brokerage password, moves to a different state, and accidentally leaves that money in the fund for 15 years, he's getting eaten alive. That 1% fee is a parasite that will drag down his compounding returns year after year after year, with no end in sight.
Class C is strictly for short-term time horizons, usually 1 to 3 years. If you're staying longer, the math turns against you viciously. Okay, listener, listen up. I am going to give you a scenario that is practically guaranteed to show up on your exam. It will look something like this. A married couple comes to you. They just inherited $200,000 from an aunt. They want to invest this money to pay for their newborn daughter's college education 15 years from now. What share class should you recommend? I want you to think about the time horizon, think about the dollar amount, and answer right now out loud.
Give him a second to think.
The answer is always Class A. Do not overthink it. Do not try to get clever. Large sum of money plus a long time horizon equals Class A. The math will always favor paying the upfront load to secure the lowest possible ongoing fees over a 15-year period. Recommending Class B or Class C in that scenario is not just wrong, it's practically malpractice in the eyes of the exam.
That is a guaranteed point if you just remember that formula. Long-term, large amount, Class A.
Which brings us to a massive question. We know Baller Brenda loves Class A shares, but we also said Brenda hates paying retail prices. She demands VIP discounts. How does she use her wealth to crush those front-end sales charges? Let's dive into hacking the fees.
This is where we introduce breakpoints. A breakpoint is simply a volume discount on the front-end sales charge of a Class A share. Mutual funds publish a tiered schedule in their prospectus to incentivize you to bring them more money.
It's the Costco model. You go to the corner store and buy 1 roll of toilet paper, you pay a ridiculous premium per roll. You go to a warehouse club and buy a pallet of 10,000 rolls, the price per roll plummets.
Exactly. A breakpoint schedule might look like this. If you vest under $25,000, you pay the maximum 5.75% load. But if you cross the $25,000 breakpoint, the load drops to 5.0%. If you cross $50,000, it drops to 4.5%. And if Brenda drops $1 million in, the load might drop all the way to 0%. She pays no front-end load at all, but gets the cheap internal fees of Class A.
Best of both worlds. But listener, recall the trap we just laid out. Breakpoints apply only to which class?
Class A shares only. You cannot get a volume discount on a Class B or Class C share.
Okay, now let's introduce a very dramatic, highly testable regulatory scenario involving cautious Carl. Carl has been scrimping and saving for years. He walks into his broker's office. Let's call the broker Sleazy Steve. Carl sits down in the leather chair and says, "Steve, I finally did it. I have $49,500 to invest in this Class A mutual fund." Steve looks at his computer screen. He pulls up the breakpoint schedule for this exact fund. He sees that the next discount tier triggers at exactly $50,000. Under 50K, the fee is 5%. Over 50K, the fee is 4%. Steve does some quick mental math. If he lets Carl invest $49,500, Steve gets a 5% commission. If he tells Carl to add just $500 more, Carl crosses the breakpoint, the fee drops to 4%, and Steve makes a smaller commission. So Sleazy Steve stays perfectly silent. He smiles, takes Carl's check for $41,500, and executes the trade. Carl pays the higher fee. Expert, what just happened in that office?
A massive FINRA Rule violation just occurred, specifically a violation of FINRA Rule 2342. It's called a breakpoint sale violation.
But wait, let's play devil's advocate. Carl walked in and explicitly asked to invest $49,500. He signed the paperwork. Steve did exactly what the client requested. How is that a violation?
Because brokers have a fiduciary duty to disclose material facts to their clients. Being $500 away from a massive discount is a material fact. By keeping his mouth shut to protect his own commission, Steve put his own interests above his clients. It is the broker's affirmative legal duty to stop the transaction and say, "Carl, look at this chart. If you can just find $500 in your couch cushions or delay this trade until your next paycheck, you will save a significant amount of money on fees for your entire $50K investment."
So failing to disclose an impending breakpoint is a violation. And here is the vicious kicker for the exam. Doesn't matter if Steve was being intentionally sleazy. What if Steve wasn't greedy? He was just incompetent. What if he just forgot to check the chart?
Intent is completely irrelevant. Whether it is malicious greed or pure negligent stupidity, a breakpoint sale is a violation by the representative. FINRA does not care why you didn't tell the client. They only care that you failed to tell them. Regulators are fiercely protective of these discounts.
Okay, so Steve gets suspended. But let's rewind the clock to a good broker. The good broker tells Carl, "Hey, you're $500 short." But Carl says, "I literally don't have it. My bank account is at zero. $49,500 is everything I have right now." Is Carl just out of luck? Does he have to pay the high fee?
Not necessarily. The industry created two specific tools to help investors capture these discounts, even if they don't have a massive lump sum of cash sitting in front of them today. Those tools are rights of accumulation and letters of intent. Let's start with rights of accumulation, or ROA.
I love ROA. I call it the running tab at the bar. The concept is that Wall Street actually rewards your loyalty over time. How does the running tab work?
ROA allows an investor to count the value of their existing holdings within a specific fund family toward the breakpoint calculation for a new purchase. You get to stack your new money on top of your old money to reach the discount tier.
Let's break the math down. Carl invested $40,000 into the Fidelity Fund family 3 years ago. The market has had a tremendous bull run. That original $40K investment has grown, and his account balance is now worth $50,000. Today, Carl gets a bonus at work. He wants to invest a fresh $15,000 into the same fund family. Does he pay the high fee on that $15K because it's a small amount?
Absolutely not. With ROA, the fund looks at his existing balance. And here is the major, highly tested exam trap. When calculating ROA, the fund uses the current net asset value of his holdings, not what he originally invested.
Stop and underline that in your brain. Current NAV.
It is massive. His original investment was $40K, but the fund doesn't care. His current balance today is $50,000. He's adding $15,000 in new cash. Total value for breakpoint purposes, $65,000. That means his brand new $15,000 purchase will be charged the heavily discounted load rate for the $50K to $99K tier.
That is huge. Now, what if the market had crashed? What if his $40K original investment was only worth $30K today?
It cuts both ways. If his account is only worth $30K today, his ROA credit is only $30K. The running tab is strictly based on what the account is worth right now. Also, it's important to note that ROA can cross different accounts as long as they belong to the same immediate family and are within the same fund complex. Carl's IRA, his joint account with his wife, and his kids' custodial accounts all stack together to push him up the breakpoint tiers.
It's a powerful tool. But what if Brenda wants a massive discount today, but she hasn't built up a running tab yet? She's starting at zero, but she knows she's going to receive a ton of cash over the next year from selling her business, and she wants to spread her investments out. That brings us to the letter of intent, or LOI.
The LOI is a forward-looking promise.
It's the coffee shop loyalty card. You walk into a new cafe and say, I really like this place. I am promising you right now, I am going to buy 100 lattes over the next year. I want you to give me the bulk discount price starting today on latte number 1. And the cafe manager says, okay, sign this legal contract. What are the rules of the LOI?
An LOI is a formal document where the investor pledges to invest a specific amount of money over a 13-month period. Let's say Brenda signs an LOI pledging to invest $100,000. The fund company says, great. Every single dollar Brenda invests over the next 13 months gets the discounted breakpoint rate associated with the $100,000 tier right from day one.
13 months forward, that is a highly specific, heavily tested time frame, not 12 months, 13 months. And there's a backward-looking feature too, right?
Yes. An LOI can be backdated up to 90 days. Let's say Brenda invested $20 K last month and paid a high fee, and today she realizes she wants to do an LOI for $100. She can backdate the LOI 90 days to capture that prior purchase, and the fund will actually refund her the difference in the overpaid sales charge.
13 months forward, 90 days backward, burn those numbers into your brain. But here's the ultimate drama of the LOI. Let's say Brenda signs the $100 K pledge. Month 1, she puts in $20. Month 2, another $20. She's getting massive discounts. But in month 6, her business goes bankrupt. She has no more money to invest. The 13 months expire, and she only invested $40,000 total. She completely missed the $100K goal. What happens? Is she legally forced to finish the LOI? Will the mutual fund send lawyers to sue her for breach of contract?
No. The LOI is completely 100% non-binding on the investor. She can simply walk away. The fund cannot sue her to force the remaining payments.
But wait, the mutual fund isn't stupid. They gave her VIP pricing on that first $40,000 based on a promise she just broke. They essentially got ripped off. How does the fund make themselves whole?
Escrow. This is the mechanism that protects the fund. When Brenda makes her purchases under an LOI, the fund doesn't just hand her all the shares. They take a small portion of the shares she bought and lock them in an escrow account. If Brenda fulfills her 13-month pledge and hits 100K, the fund unlocks the escrow account and hands her all her shares. She wins. But if she fails to hit the target, the fund quietly opens that escrow account, liquidates exactly enough of her shares to pay themselves the difference between the discounted sales charge she did pay and the higher retail sales charge she should have paid based on her actual $40K investment.
So they just reach into the pot and take their money back. Here is the classic exam question, listener. Who does the escrow account in an LOI protect?
It protects the fund company. It ensures they get their proper commission if the investor bails. It does not protect the investor.
Beautifully explained. All right, we've navigated the front door, you paid the bouncer, or you hacked the fees to get in, but what are you paying to stay in the club? Because the fund doesn't run on air. Let's move into the hidden costs, the internal drag.
This is where we have to formally confront the 12B1 fee. We mentioned it when discussing Class B and C shares, but it requires a deep dive of its own. Named after SEC Rule 12B1 from 1980, this is an annual fee charged by the mutual fund to cover distribution, marketing, and shareholder service expenses.
Let me translate that into plain English. It is a marketing tax. You, the existing investor, are having your money siphoned out of the fund every year to pay for Wall Street to run television commercials, print glossy brochures, and pay commissions to brokers to convince other people to buy the fund you already own.
That is essentially what it is.
Yeah.
The original logic in 1980 was that if the fund used this money to market itself and grow larger, the economies of scale would eventually lower the overall management costs for everyone. Whether that actually happened is a matter of intense debate. But mechanically, the fee is deducted directly from the fund's assets, meaning it quietly reduces your net asset value over time.
It's an invisible bleed. Now, because this feels dangerously close to a conflict of interest using investor money to pay for the fund company's advertising, the SEC put massive guardrails around it. How hard is it to implement a 12B1 fee?
It's very strict. To implement or continue a 12B1 fee, it requires 3 levels of approval. It must be approved by a majority of the outstanding voting shares, the investors, a majority of the full board of directors, and, most importantly, a majority of the non-interested independent directors. The directors who don't work for the fund company have to explicitly agree that this fee benefits the shareholders.
And what is the absolute ceiling? How high can they crank this fee?
The absolute legal limit set by FINRA for a 12B1 fee is 1.00% annually. That is composed of a 0.75% maximum for distribution and marketing and a 0.25% maximum for shareholder services, totaling 1.00%.
Now, I want to expose one of the sleaziest legal definitions on the entire SIE exam. It involves the term no-load. Earlier, we defined a load as a sales charge. A no-load fund is a fund that has absolutely zero front-end sales charge and zero back-end CDSC. It's totally free to enter and leave. Sounds great. But How much can a fund charge you in internal 12b1 marketing fees and still legally market itself on TV as a no-load fund?
A fund can charge up to 0.25% in 12b1 fees and still legally call itself a no-load fund.
Does that not blow your mind? Hi, come buy our no-load fund. It's completely free of sales charges. Also, look at the fine print. We are quietly taking 0.25% of your entire life savings every single year to pay for this very commercial you are watching. The SIE loves to test that exact threshold. If a fund's 12b1 fee is 0.26%, it loses the right to call itself no-load. It must be strictly 0.25% or less.
That 12b1 fee, whether it's 0.25% or a full 1%, is just one ingredient in a much larger soup known as the expense ratio. Every mutual fund has an expense ratio. It is the ultimate metric for how expensive a fund is to own. The formula is total annual operating expenses divided by the average net assets of the fund.
What exactly goes into that blender? What are operating expenses?
The biggest chunk by far is the management fee. That is the money paid to the investment advisor, the actual portfolio managers picking the stocks. Then you add in the 12b1 fees we just discussed. Then you add administrative costs, legal fees, the auditor's fees, the custodian bank's fees for holding the securities. You mix all of that overhead together, divide it by the fund size, and you get a percentage, say 0.8%. That is your expense ratio.
Okay, here's an exam trap I want the listener to catch. I am going to ask you a question, and I want you to think about what we just put in the blender. Does the expense ratio include the front-end sales charge?
Let him answer.
It absolutely does not. Never mix those two concepts up. Sales charges or loads are a one-time transactional cost. You pay it once to the broker when you buy the fund. The expense ratio measures the ongoing annual operational cost of running the fund itself. Sales charges are outside the fund. Expense ratios are inside the fund.
Perfect distinction. Okay, let's look at one more way money moves around. Let's talk about fund exchanges. Short-term Sam currently owns the mega growth tech fund managed by Fidelity. He wakes up, reads the terrifying article about AI regulation, gets totally spooked by the tech sector, and decides he wants to move all his money into the Safe Harbor Bond Fund, which is also managed by Fidelity. He executes a direct exchange within the same fund family. What happens with his sales charges?
This is one of the great benefits of staying loyal to a fund family. Generally, under the exchange privilege, a fund family will allow Sam to move his money from one of their funds to another at the net asset value. This means he does not have to pay a new front-end sales charge to enter the bond fund. Sam is thrilled. He thinks he just executed a massive portfolio shift completely for free.
But wait. Cautious Carl is standing in the corner. He's adjusting his tinfoil hat. He's pointing a trembling finger at a shadowy figure in the background. Who is Carl terrified of?
He is terrified of the IRS.
Yes, he is. Why? Sam didn't take the money out of Fidelity. He just moved it from pocket A to pocket B.
The IRS does not care about fund families. To the IRS, the Mega Growth Tech Fund and the Safe Harbor Bond Fund are two completely separate legal entities. When Sam clicked exchange, the IRS viewed that as a legally binding sale of the tech fund, followed by a new purchase of the bond fund. It is a fully taxable event.
A taxable event.
Yes. If Sam had built up $50,000 in capital gains in that tech fund over the years, the moment he exchanges into the bond fund, he legally realizes those gains. He will owe capital gains taxes on that $50,000 this year, even though he never actually touched the cash.
Boom. The exam will try to lure you into thinking same family means tax-free. It doesn't. You dodge the sales charge, but you get hit by the tax man. Now, just to briefly foreshadow our next section, there is a specific type of product where you can exchange funds and actually dodge the tax man legally. And it's not a standard mutual fund. It's an insurance product utilizing a section of the tax code called a 1035 exchange.
Which leads us perfectly into the deepest, weirdest, most heavily regulated part of the SIE, the hybrid, variable annuities.
If a mutual fund and life insurance policy fell in love and had a baby, it would be the variable annuity. It is a profoundly complex product because it has a dual nature. It exists in two worlds at once.
It is the ultimate crossover episode. Explain the dual nature. Why does this thing exist? An annuity, at its most basic level, is an insurance contract that promises to pay you a stream of income in the future, usually to ensure you don't outlive your money in retirement. Traditionally, annuities were fixed. You give the insurance company money, they put it in their general account, and they guarantee you a 4% return. Because it's a fixed guarantee, the insurance company bears all the investment risk. Therefore, a fixed annuity is strictly an insurance product. It is not a security.
But inflation is the enemy of fixed returns. 4% might sound great today, but in 20 years, it might barely buy a loaf of bread. Investors wanted a way to keep up with the stock market.
Exactly. So the insurance industry invented the variable annuity. Instead of putting your money in their general account and guaranteeing a return, they put your money into what are called separate accounts or subaccounts. These subaccounts function exactly like mutual funds. You get to choose how your money is invested. You can put it in a growth subaccount, a tech subaccount, a bond subaccount.
But because my money is now riding the roller coaster of the stock market, the insurance company can no longer guarantee my return right.
Correct. The cardinal rule of a variable annuity is that returns are not guaranteed. The investor bears the investment risk. If the stock market crashes, the value of your annuity crashes. Because you are taking market risk, the SEC stepped in and said, hold on a minute, that's not just insurance anymore, that is a security.
Which means double the red tape. This is a huge exam point. To sell a fixed annuity, you just need a standard life insurance license from your state. But to sell a variable annuity, you need dual licensing. You need your state life insurance license, and you need a securities license from FINRA, like a Series 6 or Series 7. You are answering to two different masters.
Yes, dual regulation. So why would anyone buy this? If you are just investing in mutual fund-like subaccounts, why not just buy a normal mutual fund and skip the massive insurance fees? There are two massive tax and structural advantages. To understand them, we have to look at the life cycle of an annuity, which is divided into two distinct phases. Phase 1 is the accumulation phase.
The building phase. You are rolling the snowball. During the accumulation phase, you are putting money in. Maybe it's a lump sum. Maybe you're making monthly deposits. What is the tax advantage here?
Tax-deferred growth. While the money is sitting in the separate account, you do not pay any capital gains taxes, and you do not pay taxes on dividends. The money compounds year after year without the IRS taking a slice.
But wait, an IRA does that too. Why not just use an IRA?
Contribution limits. The IRS says you can only put a few $1,000s a year into an IRA. But a non-qualified variable annuity has no contribution limits. If Baller Brenda wins the lottery tomorrow and wants to dump $5 million into a variable annuity to get tax-deferred growth, she can do it instantly.
No limits. That is a huge draw for high net worth individuals. But the IRS is patient. They always get their pound of flesh eventually. The government gives you tax deferral because they want you to save for retirement. If Brenda treats this annuity like a standard brokerage account and decides to pull her money out early to buy a yacht before she turns 59 and a half, what happens?
The IRS drops the hammer. If you withdraw money from an annuity before age 59 and a half, the IRS slaps you with a 10% early withdrawal penalty on all the earnings. And Andy, you have to pay standard ordinary income tax on those earnings. It is a brutal tax hit.
Okay, so you leave the money alone, you let it grow, you reach age 65, you are ready to retire. You transition from phase 1, accumulation, to phase 2, the annuitize phase. This is where you pull the ripcord. What does it actually mean to annuitize?
It means you permanently trade your lump sum of accumulated wealth to the insurance company in exchange for a contractual guaranteed stream of income, usually for the rest of your life.
I want the listener to really feel the weight of that transaction. You literally give up your principal. If your snowball grew to $1 million, you sign a paper and hand that $1 million over to the insurance company. It is no longer your asset. In exchange, the insurance company promises to send you, for example, $5,000 every single month until the day you die. It's generally irrevocable. You cannot change your mind 3 years later, call them up and say, hey, I'd rather just have my lump sum back.
That's right. You traded liquidity for a lifetime guarantee. And here's a massive, highly tested exam trap regarding taxes during the annuitization phase. When those $5,000 monthly checks start rolling in, how are the earnings taxed?
Well, the sub-accounts were invested in the stock market. So it should be long-term capital gains, right? The cheap tax rate.
Wrong. The exam will try to bait you into saying capital gains. The earnings portion of an annuity payout is always taxed as ordinary income, your standard tax bracket. It does not matter if your money was invested in stocks for 30 years. The moment it pays out from an annuity contract, the IRS treats it as ordinary income.
High tax brackets. Okay, so you pull the ripcord, you get the monthly checks. But how long do the checks actually last? What happens when you die? That depends entirely on your payout option. The exam tests three main ones, and they're basically a sliding scale of risk versus reward. Let's volley these. Payout option number 1, life only.
Life only, or straight life, gives you the absolute highest monthly payout check. The insurance company calculates your life expectancy and pays you a massive amount every month, but it carries extreme risk. The company pays you until the exact day you die, and then the payments stop completely, period.
So if Carl annuitizes on a Monday, receives his first check, and then gets hit by a falling piano on Tuesday, what happens to his $1 million?
The insurance company keeps it all. They won the bet. Carl leaves absolutely nothing to his heirs from that contract. Highest payout, highest risk of forfeiture.
Carl would have a heart attack just thinking about that. He wants a safety net. So he looks at option number 2. Life with period certain.
Carl accepts a slightly lower monthly check, but he buys a guaranteed. Let's say he chooses a 10-year period certain. The insurance company promises to pay him for the rest of his life, no matter how long he lives. Petit, if he dies in year 4, the company is contractually obligated to continue making those payments to his named beneficiary for the remaining 6 years of the guarantee period.
Okay, so his kids get something if he dies early. What if Carl lives to be 100? What if he lives 25 years after annuitizing?
He keeps getting paid for all 25 years. But when he finally dies in year 25, the payments stop immediately. He far outlived the 10-year certain period, so his kids get nothing.
And finally, payout option 3, joint and last survivor.
This is typically utilized by married couples. The payments continue as long as either person is still breathing. If the husband dies, the wife keeps getting the checks. Because the insurance company is now on the hook for 2 entirely separate lifetimes, they know they are going to be paying out for a very long time. Therefore, this option usually offers the lowest monthly payout check of the 3.
Now, listener, listen to everything we just described. Tax penalties for leaving early. Irrevocable decisions to give up your principal. Massive surrender charges if you want to cancel the contract during the accumulation phase. Because variable annuities are so complex, so illiquid, and carry such hefty hidden fees, FINRA Rule watches the sale of these things with a microscope. Brokers historically loved selling them because they generated massive commissions, sometimes to people who had no business buying them. Which brings us to one of the most important regulatory rules on the exam. FINRA Rule 2330.
Rule 2330 specifically targets deferred variable annuities. It sets incredibly strict suitability requirements. A broker cannot just sell a variable annuity to anyone with a pulse. They have to deeply, documentedly analyze the client's age, their income, their existing assets, their investment experience, and most importantly, their need for liquidity. If you sell an 85-year-old woman a product that locks her money up for 10 years with massive surrender charges, you are going to lose your license.
And FINRA doesn't even trust the broker to make that call alone. Rule 2330 requires a registered principal, which is basically a branch manager or compliance boss, to physically review and approve the application before it goes to the insurance company. And the exam wants to know the exact time frame for that boss's review. What is it?
The principal must review and approve or reject the application within 7 business days.
Stop right there. Notice the shift in terminology. Earlier, when we talked about mutual fund redemptions, what was the time frame? 7 calendar days? But for an annuity principal review, it is 7 business days.
That is exactly the kind of granular, easily confused detail that separates a pass from a fail on the SIE. Mutual fund payouts, 7 calendar days. Annuity application reviews, 7 business days.
And there is one more critical, highly tested piece of Rule 2330, the 36-month rule. FINRA has a tripwire system. They heavily scrutinize a broker who recommends that a client exchange one variable annuity for a different variable annuity within 36 months of the original purchase.
And you should understand why. It comes back to the 1035 exchange we mentioned earlier. The IRS allows you to swap one annuity for another without triggering a tax event. Brokers used to use this as an excuse to churn accounts. They would tell the client, hey, let's swap your old annuity for this shiny new one. It's totally tax-free. And the broker would generate a massive new commission.
But what did the broker fail to mention?
They failed to mention that while the IRS might not charge taxes, the insurance company will still hit the client with a devastating surrender charge for leaving the old contract early. The 36-month rule forces the firm to prove that the new annuity is significantly better for the client than the old one, justifying the massive fees incurred by the swap.
It is a profound legal responsibility to sell these products. Wall Street cannot just shove these complex machines into people's hands without warning them, which is the perfect segue into our final section. Reading the label. Disclosures. The SEC operates on a philosophy of disclosure. They generally won't stop you from making a terrible investment, provided you were given all the facts beforehand. They will not let you buy any of the packaged products we discussed today without reading the legal nutrition label first.
That nutrition label is the prospectus. It is the ultimate legal shield for the fund company and the ultimate disclosure document for the investor. It contains the fee table, the breakpoint schedules, the investment objectives, the risks, and the manager's history. But the exam doesn't just want to know what a prospectus is. It wants to know exactly when it must be delivered.
This is the golden rule of primary offerings. The prospectus must be delivered to the investor before or at the time of sale.
It cannot be late.
I'm going to say it again. Louder. Before or at the time of sale. The exam will try to trick you. They will give you a multiple choice option that says the prospectus can be delivered in the mail alongside the trade confirmation after the sale is complete. You must cross that option out immediately. It is dead wrong. You cannot sell someone a highly complex financial product, lock up their money, and then hand them the list of risks a week later. They must have the ability to read the risks before they commit the capital.
Now, full statutory prospectuses are massive, dense legal documents that nobody actually reads. To fix this, the SEC allows mutual funds to use a shorter version called a summary prospectus. It's essentially the highlight reel, just a few pages covering the most critical info like fees and objectives, making it actually readable for a normal human.
But if a fund hands you a summary prospectus, the full, massive statutory prospectus must still be available online or physically if the investor demands it.
No, wait. Cautious Carl read the summary prospectus. He read the 50-page statutory prospectus. And because Carl is deeply paranoid, he says, I want more. I want to see the granular audited financial statements. I want to know exactly what the board of directors is getting paid down to the penny. I want the deep, deep legal compliance details. Does this document exist?
It does. Carl can ask for the Statement of Additional Information, or the SAI. It is sometimes referred to as Part B of the fund's registration statement. It contains all the deep, nerdy financial data that normal investors do not care about.
And here's the final exam trap of the day. Is the SAI automatically delivered to every investor when they buy a mutual fund?
Give them a beat.
No, the SAI is never automatically delivered. It is available upon request only. The summary or statutory prospectus is mandatory and automatic. The SAI is only printed and mailed if you explicitly ask for it.
Boom. Let the gears of the machine slow down. You have officially navigated the building codes of 1940, the pricing mechanisms of open and closed funds, the fees, the weird annuity hybrids, and the disclosures. Take a deep breath. We are going to land this plane with a rapid-fire recap of the top 5 most highly testable traps from this entire deep dive. Listener, try to anticipate the answer. Ready? Number 1, pricing. Open-end mutual funds use forward pricing at NAV, calculated once a day at 4:00 p.m. Eastern. Closed-end funds trade on a secondary exchange, meaning their price is based on supply and demand, allowing them to trade at a premium or a discount to NAV.
Number 2, breakpoints.
Volume discounts apply only to Class A shares, and if a client is hovering just below a breakpoint threshold, failing to inform them is a breakpoint sale violation by the representative, regardless of intent.
Number 3, discount mechanics.
Letters of intent last for exactly 13 months, can be backdated 90 days, and are completely non-binding, though escrowed shares will cover the difference if the pledge is unfulfilled. Rights of accumulation look at the current NAV of your existing holdings, not your original purchase price.
Number 4, fund exchanges.
Switching from a tech fund to a bond fund within the exact same fund family avoids a new sales charge, but it absolutely triggers a taxable capital gains event with the IRS.
And number 5, variable annuities.
They are dual-regulated securities. During accumulation, they offer tax-deferred growth with no contribution limits. When annuitized, withdrawals are taxed as ordinary income, not capital gains. And a principal must review the application within 7 business days.
Phenomenal. All right, as we wrap up, I want to leave you with one final provocative thought to mull over while you study. Think about that 12b1 fee rule we debated. The SEC allows a mutual fund to legally market itself on national television as a no-load fund, heavily implying to the public that there is no sales cost, while quietly siphoning off up to 0.25% of your assets every single year to pay for their own advertising.
Right.
It forces us to step back and ask, where's the line between an internal operating fee and a hidden sales charge? When you buy a mutual fund, who is really paying for Wall Street's massive marketing budget, you are, the money doesn't come from the sky, it comes straight out of your compounding returns. Ponder that the next time you look at a fund's expense ratio and wonder why your personal returns are just a little bit lower than the broader market average.
It is a critical distinction that separates an informed investor from a passive participant. Keep questioning the mechanics behind the curtain.
Exactly. All right, that X-ray machine we talked about in the beginning, the one that shows a clean, binary, easy to understand financial system, it doesn't exist. The waters are muddy, the rules are layered, and the traps are everywhere. But now you've got the blueprints to navigate them. Keep studying, keep spotting those traps, and we will see you next time.